Welcome to the Thoughtful Software Podcast with your hosts, Andrew Wolf and Fahad Shokat. Thoughtful software is a set of values, principles, and techniques to fuel digital innovation. We want to help usher in a new approach to the way software is imagined, designed, and built. Our guest for this episode is Silicon Valley veteran Samir Kaji. Samir is the managing director at First Republic Bank, a Kaufman fellow, and a source of truth for venture capital and emerging VC funds. Together, Fahad and Samir discuss how the current COVID crisis is affecting venture capital and startups and what we can expect moving forward.
So, Samir, we're in the midst of a global pandemic, and COVID is everywhere in every country except Antarctica. And when it comes to business, I just recently read Mark Cuban say that it resets everything. And many businesses are failing, but there are also new opportunities as well. And you are and have been knee-deep in venture capital, banking, and startups for the last 20 years. So I'm very interested to hear from you about the current state of VC and startups as we navigate this crazy environment. So as we record this in early April 2020, how is the health of VC today and what's changed so far?
It was a good question. So I think that, fundamentally we have to take a step back and accept the fact that we're still very early in understanding how deep this COVID, global pandemic is going to cut, how long it's going to be. We still don't have a vaccine, obviously, one that still could take 12 to 18 months. And so I think it's too preliminary to provide any sort of medium-term outcomes. But I will say, the answer to the question, from two lenses. One is the short term, and then the second is the long term. When you ask about venture capital health today, in the short term, things are going to get incredibly stressed, both in terms of VCs fundraising from limited partners and companies getting funding from VCs. Now, there is a little bit of a silver lining in the sense that VC funds raised a lot of money in 2019, 2018, and even in the beginning of this year, which gives them a lot of dry powder to continue investing in companies. Now, that said, everybody's resetting their risk return parameters right now and understand that in order to invest in this very uncertain market, that VCs are going to be much more deliberate in the term sheets they write. Valuations will come down, and acquiring capital is going to be very, very difficult relative to the last 12 years. However, long term, if you look at it, we are still in the early decades of a technological revolution. And so if you look back in history, it started off with mainframe computing, then personal computing, then the internet, then smartphones. And if you look at where we are from a technological standpoint, it's bringing all of those frameworks together to create a world where we will eventually have technological adoption being ubiquitous across every single industry sector. A lot of these industry sectors, by the way, are still very early in adopting. And, you can look at things like manufacturing and ag and food and bev, and you see the changes that are happening largely because of technological innovation. What's happening with COVID is we are now finding where those inefficiency lies, and we're finding out problems that we didn't know we had before. So I do think that in the long term, and, quite frankly, the medium term venture health is going to be very strong, but we're going to go through a tough 1, 2, and maybe even 3 years.
You don't see like any near term or like even the deals that were in progress before COVID kind of hit in danger. So I would assume like short term deals are still going to kind of go through. And then maybe in the next few quarters, things are going to get really compressed.
Well, I think what's already happening, I think, most VCs will signal the fact that they're still open for business. I would posit by saying that open for business means something very different today than it did 3 weeks ago or even 2 weeks ago. And what I mean by that is there are reports of VCs, and I've seen it myself, pulling term sheets or horse trading some of those terms that were in there for things that were more favorable. Now, does it make sense to do that? I think that if you take the deal by deal lens on, say, is the risk profile higher for any given company? And therefore, as a VC, should I get a better return profile for the risk that I'm now taking? The answer is probably yes. But if you look at, VC, it's very much, game theory where every deal ties into another deal and it ties into your reputation. And so, I would counsel, not to do that where you can. I think people tend to remember. And, we're in a very, very difficult time, something that we haven't seen probably for 100 years. And these are the times when people remember how you act. And the best in the business and the best people in the world tend to shine brightest when things are dark like this. And so, the short answer to what you said is deals generally are still getting done, but not at the pace that we've seen before. It's already happening, not at the same valuation. It's already happening. And we are seeing some bad behavior exhibit whereby people are actually pulling term sheets on deals that they had already issued term sheets on.
Wow. Do you see like the big VC firms still pretty active, and how are the smaller VC firms doing?
So okay, so let's just define that a little bit more. So big VC firms are firms that maybe have been around for a long time. Significant AUM, maybe AUM well over $1 billion with multiple funds, institutional LPs, things like that. Generally speaking, they're well positioned right now. I think it's going to be tougher for them to raise the type of funds outside of maybe 5 to 10 funds in the US that can continue to raise really, really big funds even in this environment. I think for the most of them, they are continuing to be able to write term sheets. I think at a low valuation market, this is a great buying opportunity. We've seen some of the best companies in the world formed really in any market cycle. And, there are the Uber and Airbnbs. Of course, there's not many of them, but, as a big firm, you have the opportunity now to be risk controlled a little bit, or sorry, return controlled by investing in companies at a lower valuation where you may be the only game in town or a very select few that are in the market of actually investing in these companies. And I think fundamentally entrepreneurs are going to be forced to be more resourceful in how they use their funds. I mean, we've had a lot of bad behavior in the last 6, 7 years, and certainly over the last few years where it's been growth at all costs without looking at unit economics. I think that world is over. And so anyone that has dry power to invest, I think is going to have a really good opportunity from a return perspective over the next couple of years. On the small fund side, the biggest challenge, of course, is can I raise enough capital to be able to deploy in a market where investing historically has probably been the best, which is you want to invest when things are, at the lowest point and be in front of the inevitable wave up. A lot of those funds are going to have a tough time raising because they rely on, family offices, high net worth individuals. And a lot of those folks are just not going to invest in private assets when, liquidity is a premium. They might be losing their jobs. Maybe their public stock portfolio has gone down 50%. It's going to be, carnage for a lot of those small firms. And so I think some of that behavior may dictate how active they can be and where they play. But fundamentally, look, there's still going to be a lot of risk capital out there. The best companies tend to still get funded. Marginal companies will have to, figure out contingencies, and we've seen that before. Is that a terrible thing? It's terrible from the lens of the individuals that work at these companies and losing their jobs, and people that have put in a lot of work to start a company. But I think at the end of the day, we will come out stronger. It's just a matter of how much pain we have to go through before we get to the other side.
I'm curious on how the market's going to change, because now you're seeing a shift towards like a downward shift towards valuations. Funds, probably going to increasingly add like liquidation preferences and maybe like dividend rights and other investor protections into funds. And so startups are going to basically have to adjust with less money and more sort of restrictions. Are you seeing that across the board, or just certain funds are kind of implementing those?
Well, I think that, look, just by nature, all equity rounds typically have a liquidation preference of 1x. If you're asking about things like participating preferred and, investors having more than a 1x liquidation preference for distressed companies, I think you'll see some of that type of behavior. I haven't seen it yet. And I think where we're seeing the tip of the spear right now is really a reduction in the valuations across the board, anywhere from, 10 to 40%, depending on stage and depending on the type of company. And of course, we've seen a lot of stress at that later stage, and SoftBank being really the firm that's been in the news the most, and some of the hits that they've taken.
What are your thoughts on SoftBank and like mega funds versus traditional VCs?
Well, I think just generally speaking, the difficulty of any VC or just the VC industry is of scale of capital. It's very difficult to return the type of capital your LPs would want to do it at a really large scale. So, I mean, most funds you want to get to a 2.5, 3x net for your LPs. At $100 billion fund, you are relying on incredibly massive exits where you own a huge piece of the company to even get to maybe a 1.5x. Now, I don't view SoftBank as a traditional venture fund. It's not. They were a growth player that it was really focusing on, investing in category leading companies, putting big bets at incredibly high valuations, and hoping that the public markets or downstream markets to them would be able to take those companies at higher prices. I think that that strategy clearly has not worked. I think that firm and that fund itself in SoftBank Vision Fund One is going to have a really rough return profile. I don't think that's anything that's surprising when you hear about WeWork being such a significant part of it. But I just don't see it working.
I mean, just my own personal view. I mean, it's almost like a blip. Like if they weren't around and didn't invest all this money into startups that really didn't need that much, there would have probably have been more, I guess, emphasis on just good fundamentals. But I mean, it's just almost like the last few years it's just like growth at all costs. We're not going to worry about just being profitable and running a real business. And I think that just to me is like, okay, now we got to get away from that and start like actually a real business and focus on the right things.
Yeah, I mean, look, I mean, I do think there are some companies that just their business model requires a large amount of capital, and those are emerging, some healthcare companies. I think it's some deep tech companies that require a lot of research. And there are other sort of areas where capital intensity is just needed, prior to, company launch. I think that the issue though, and this is no different than what we saw in, 2000. So if you look at the metrics in 98 to 2000, the main metrics that allowed companies to raise money and go public, through the public markets were really eyeballs, right? And so if you look at the last, decade, it's really about top line revenues. And, I think there was a podcast that Chamath, from at the time Social Capital did with Jason Calcanis, where he had mentioned, venture is just big one Ponzi scheme. And the thought there was pretty simple. It was that investors were pumping a lot of money into companies, understanding that the metrics required for follow-on capital at higher valuations was singular, which was what is your top line revenue and what are your growth metrics? And so it's a variation of the greater fool theory, which is effectively that there is a greater fool, but the greater fool is looking at the same thing, and the greater fool is hoping that there's a greater fool behind them. I think that world is gone. It's definitely started to show cracks since the middle point of last year, but at this point, those cracks are wide open, and fundamentals will have to change. The difficult thing as a startup company, though, is if you built a culture of extreme growth, extreme hiring, to pull back from that is one of the toughest, if not impossible, tasks to do when you now have to go lean. And so I think that these next couple years are going to be, again, difficult is probably understating, the real impact. But I think that, a lot of people are going to go through culture shocks, and particularly when you look at a lot of VCs and a lot of startup firms and companies and founders were not even around during the last downturn.
Yeah, I think it's interesting thought you bring up. Like it's about resetting expectations as well, right? If you're at this growth, pace, it's just breakneck speed, and that's the expectation to have such crazy returns. But now it'll be like just focused on, like what are the fundamentals? Is your market, growing? Which is another conversation because now I'm very interested in how do you actually measure the performance of a fund or any company for that matter. Because if you ask like sales guys, are they going to hit their quota in 2020 or like what were they were up to in 2020? Most of them will say, "Oh, we were just washing our hands." They're like putting it a wash. They did absolutely nothing this year, and I don't even know how to evaluate quotas or startups or anything like that. I don't know what you're hearing.
Yeah, I mean, I think it's for really tough. I think for the vast majority of companies, this is not a year where things like revenue milestones are going to mean a lot in terms of getting follow-on funding or actually, viewing whether the year was a success. It's really creating the foundational components of long-term success. And can you create the right culture? Can you realign yourself to a new reality? And are you still, building the type of products that fundamentally have durability through, the next several years, and certainly, in the post-COVID world? So I do think it's a much more nuanced and subjective measure that people will be looking for. Now, there are companies that are COVID aligned, and those are, companies like a DoorDash or Postmates, Amazon, right? That tend to do very, very well. And there's a number of those companies that I think, those revenue metrics are going to potentially be incredibly successful and great. Now, the reality is we just don't know what we don't know. We're literally, about a month into shelter in place at this point. And, we don't yet know what the second order and third order consequences of this are, let alone even, some of the depth of the first order consequences.
Yeah, I'm just, yeah, you're right. It's very early, and I'm just really fascinated by just, how we're going to end up with this year. I don't see it like for our company as well. We're not really sure how even clients are going to end up. So far, critical projects are still ongoing, and I would say like critical businesses are still going to be ongoing. But you're going to find a lot of companies that are just kind of add-ons or nice to haves. Really, they're going to have to evaluate what their business model is and how they're going to move forward.
Well, I think that, you're right, but I think it does create a forcing function for those CEOs to actually evaluate their business and look at things, and instead of just focus on a singular measure of revenue growth, it's more around, is my product, is my company actually viable, and what are the things that I need to actually do to actually create long term value? I think the best founders and the best CEOs view this time as an opportunity to reset, rethink, reflect, and look at creating value streams that they may not have thought were there or didn't have time to actually look at. And so I don't know. Look, I mean, like any downturn I've been through, this is my third downturn I've been through. This is probably going to be the worst one. I always feel like, you have to look at these times as opportunity sets. And the best ideas often come with problems. I mean, there's this long adage that, the best startups are solving fundamental problems and providing, aspirin versus a vitamin. And I think it's right now time for startups to understand what that pain point is and what aspirin they can create. And I think the best founders will figure it out.
What opportunities do you see from venture capital standpoint? Like, what do you see from them that they could potentially, look at, get into? Anything interesting so far? I know it's still early, but anything interesting come up?
Well, I still think everything's interesting, to be honest with you. I've never been too interested in just, surface apps, things like that. But I do think that if you look at the long-term picture, which I mentioned before, and look at all these different industry sectors that could use a technology to really increase efficiency and be able to weather these type of cyclical storms. I mean, the opportunities are all over the place. But I mean, if you were looking at certain areas, I mean, of course, healthcare has reared its ugly head during this time. Drug discovery, I think that areas in deep tech continue to be really interesting. Anything that related to supply chain and logistics. So, I mean, there's so many areas, but I've never been a fan of looking at transient, trends and saying this is what a VC should invest in. I think as a VC and smart VCs understand that you are predicting the future of what the world will look like. You are investing in companies that you think are solving really interesting problems, and founders that have the ability to pivot and really understand their customer base and change dynamically. And so That's really, the answer I've always come toward, and I've always been more medium and long term thinking versus like what will happen over the next quarter.
I mean, if you look at a lot of, even let's take gyms for example, businesses like that are brick and mortar are gonna, obviously have to put some kind of like online component into their business, and most businesses are gonna have to start thinking about that. And I was talking to somebody about companies not just having to go through digital transformation, but it's almost like remote transformation.
Yep.
So any business that's kind of involved in that seems really fascinating to me. Like you see Zoom. Zoom is one great example, but they're struggling right now. um, so yeah, I'm interested. I think it's a good point though. I don't think there's one specific thing.
Yeah, well, they're certainly struggling from the standpoint of just the volume and the some of the hacks that have happened where people have Zoom bombed certain other Zoom meetings, and I think for Zooms, just I think they've just done a fantastic job in getting in front of things, fixing things quickly, and what they've shown though is there is a huge opportunity for the remote workforce. And I look at our own institution. I mean, we have roughly 5,000 employees, a little bit under, and historically, you go into the office every single day. And the thought was, if you did not go into the office and you didn't have all people going into the office, how are you going to serve your clients? How are you going to run processes? What we found out over the last month is not only uh, can we continue to do those things, but in some ways we're being more effective, more efficient, and being able to actually do more than we thought was even possible under the old construct. And if you think about it from the standpoint of a company having a lot of money tied up in office spaces, let's say an average company or an average financial institution has 1,000 employees. Of those 1,000 employees, they build offices to house those 1,000 employees. In tomorrow's world, we could see some of these companies make the determination that their office space should only hold 200 or 300, that they can
Right.
use distributed teams. They can have teams in lower cost areas. They could, have the 300 person office cover all those 1,000 people. And when you look at the efficiencies that are created by being at home, not having to spend an hour, maybe even more in the Bay Area in traffic, you will see those conversations happen. And so, I think office buildings, anyone that's a landlord is going to have to go through some very difficult realizations on whether to dramatically reduce rent to avoid massive vacancies, or what we're going to see is people determining that they don't really need a new or a traditional office environment.
Yeah, I find it interesting. I mean, you'll see VC also, I think, kind of shift as well. Where anybody who's trying to start a very capital intensive, kind of feet on the street, peer to peer, face to face type business is going to get highly scrutinized. And I would be really shocked if anyone like that gets funded anytime soon. But companies that are more virtual and are already built that way are going to see a lot of attention and growth. Investors are going to ask them to grow even faster.
Right, right. Yeah, and look, I mean, again, these things are, really tough. I mean, I think one of the other challenges that we should have talked about earlier is that unlike past recessionary environments, and even though technically we're not in a recession, in the way it's actually financially defined, we are in a recession, and there are signs that this could be much more than that, given the unemployment rates, where we are in terms of the virus spread, and certainly, what we've seen, the impact on the economy with shelter in place effectively across most states in the U.S. But what we haven't really discussed is the mental psyche. Unlike
Right.
old, recessionary times, and for me, I've been through 2000, 2001, and really 08, 09, is that we are all at home right now. We are uncertain. We are afraid. Those type of things do filter into business decision making. And so, even if the virus went away in 6 months, which again I highly doubt, but if it did, the change in human psyche will take a while to rehabilitate. I don't see consumers going back to their spending ways. I don't see businesses going back to their spending ways. This is a very visceral, emotional time for us that transcends the traditional just economic impact.
Yeah, that's really fascinating. That's a very fascinating thought. I didn't consider that as much, like in even terms of the projects that we want to encounter, the corporations that we work with, large like Fortune 500s. I don't know how they're evaluating the future, but it definitely will go into consideration. But that leads me to a question. Besides just VC, what are you seeing like from corporations and other type of like private equity? Just what's the state there? If you have any insight there.
Well, look, not every, the vast majority of companies are not VC backed, right? And they're typically, owned, bootstrapped, owned by, and you mentioned private equity firms, but I think outside of private equity venture capital, look, I think all corporations are going through a very harsh reality of understanding that their business is going to be impacted to a point where it's possible that marginal businesses go away, that even good businesses are going to have significant cuts in how they grow and build. And so I think it's just across the board. I don't know if I have any revelations outside of what everybody is saying, which is 2020 could be it could be considered a lost year for most businesses.
And we have a lot of firms, like that have invested in companies like, Cirque du Soleil that overnight had to get rid of, lay off the entire staff almost. So you're definitely, I think, going to see a lot of changes there. One thing I wanted to touch on too also was fund of funds and micro funds. Again, I know it's still very early, but what would be the kind of trickle effect down to these other like micro funds and fund of funds?
Well, so two different things, right? So fund of funds tend to invest in other, if you're referring to venture fund of funds, into other venture funds. Micro funds typically are direct investors into usually early stage companies, traditionally at the seed level. The capital pullback will hurt them, significantly. I think that there are fund of funds that have premium access. And if you have the ability to, as a fund of funds, invest into firms like Excel and Lightspeed and Sequoia and Benchmark and Andreessen Horowitz, I think you're going to continue to raise money from those institutional LPs. If you are a fund of funds that doesn't have access into maybe 5 to 15 names in the US, I think fundraising is going to be incredibly hard because you're looking at a fee on fee model. For micro funds, it's tough. Let's say I raise a fund in 2018. I raised $25 million, maybe 20. My investors are, high net worth individuals and their family offices. I did a bunch of investing in 2018 and 19. I'm out of money in terms of making new investments, and I'm going out for my second fund right now. I don't have a lot that I can show people of that I'm a good investor, right? There's not going to be exits likely or no meaningful exits in that time. They're looking at paper gains, which likely will be downward shifting over the next year or two. And so I'm kind of stuck at this point of not being able to raise a new fund, not being in the market, and having to make the determination of whether I want to stay in VC and ride this out or continue to take care of my existing portfolio to the extent that I need to at this point, and then looking for other opportunities. I do think you'll see some of that happen. 1,200 firms were formed since in the U.S. alone since 2009. Nearly 70% of those were small seed firms. I do think there's a reality that is incredibly potential over the next 2 years that half of those will no longer be active investors by 2022.
I had like one more question, maybe, and we can wrap it up. But let's say financing does get tough, or it will for startups. What are some options that they might have?
So for startups, there's a couple of ways to think about it. One is traditional venture debt, and that usually is a function of first receiving an equity infusion from traditional venture investors. And the way it typically works is, I raise $10 million. My cash burn is $1 million a month. I'm making these numbers up. That gives me 10 months of cash. A bank or a venture debt fund provides me typically $2 to $4 million of capital. I think in the markets today, it's going to be on the lower end. And that provides me additional runway to hit milestones necessary for me to then raise my next round of capital. Over the last few weeks, companies that have already secured venture debt are pulling down on those deals. The one thing I'd say about debt in general is it amplifies returns, but it amplifies risk as well. And so, what I mean by that is it is not going to save a sinking ship. In fact, it creates an anchor that in some ways can help that ship sink quicker. Uh, Venture debt lenders are top of the priority stack when it comes to liquidation preferences. They have a senior lien on the company. And the last thing you want to do is try to raise money in a tough environment where where you've not hit your milestones and you have a lender that has a significant amount of debt on the balance sheet that is looking to get paid back. I think those are things that we've seen tank a lot of companies. And I think that generally speaking, if you haven't gone through the thought process of what does this debt actually do for me? Is it actually prudent to take it on given my visibility into milestones? It could end really, really badly. So I'm not a big fan of taking on early stage venture debt without having milestone visibility. I think that it can be used in certain areas. And I think for companies that are performing fairly well and have supportive investors, it's a great way to extend runway to achieve milestones and weather the storm. And then there's other ways that I think are more prudent of taking on debt, and those are more formula based, like lending on your accounts receivable or your recurring revenue. I think those areas where you are tying to a performance milestone or a national asset on your balance sheet, I think is much more prudent. But the use of debt, as a non-dilutive way of helping a company get through is is critical, and it will continue to be critical. And all I'm saying is that I think companies and boards should be really thoughtful about thinking about when and if they should incur debt during these type of times.
Well, what's your thought on the emergency fund and the payroll protection? I mean, that's just a more debt, but I think it's a pretty good deal for startups. Would you recommend that startups kind of look into that?
Okay, so like I spent a lot of time on this, and so let's just be clear on what the PPP is. It's the payment, or there's rather the Paycheck Protection Program under the SBA, existing SBA 7A. And it's effectively a relief aid to help small businesses retain their employees. Is it a good thing? Yeah, yes, I absolutely do think it's a good thing from the standpoint it's an uncollateralized loan yielding 1% for the lender and it's 2 years with the ability for the loan to be forgiven if the company in question adheres to certain things, which includes keeping your staff on. Um, it's been a very interesting ride over the last week. Most banks didn't get the SBA guidelines until late Thursday, and so it's been a little bit slower start for most of the major banks to actually start doing this. One thing I'd say for startups is you should talk to your counsel first. There's something called an affiliation rule, which is spoken to in Section 301. I don't want to get too technical, but what it basically means is if you have a equity holder that is let's call it a venture firm, even if they own less than 50% of the company, if they have certain rights, and those rights could include things like preventing a quorum, veto rights, they would then be deemed an affiliate. The problem with that is the PPP is only for companies less than 500 employees. If you're a company with 20 employees, but your venture firm is deemed an affiliate, then you would have to count all the employees at that venture firm plus all the employees at the company that venture firm is also an affiliate with. And so if they have 20 positions where they have the ability to prevent a quorum and therefore are in a control position, you may be precluded from taking advantage of the PPP because of the affiliation. And so all startups, before they do apply, should talk to their counsel to understand eligibility, because the risk is if you are funded through the PPP and later found to be ineligible, there could be a whole host of civil and criminal penalties. I think the good news is that with the new interim final guidance, most startup companies, particularly the ones that don't have a single large investor with a whole host of rights, will actually be eligible. And I think that, generally speaking, we're in a good place.
Like what advice would you have for like venture capital and just people in this environment, and how to navigate it, how to just kind of manage their own emotions, and what they should be kind of doing this time, and in the next few months?
Well, my answer is not going to be germane to VC. I think it's anybody running a business in a leadership position. Generally, these are the times where you define who you are, what you're made of, and what type of value you can create for the people around you and the people that you serve. And what I would say is, and I've learned this over time, is it's really easy to become emotional. It's easy to make snap decisions. It's easy to not really focus on some of the positive and the opportunities. I think that you have to be of calm mind. You have to find ways to calm yourself so you can have those thought patterns emerge. And look, I mean, over the next 12 to 18 months, because you will see a lot of marginal leaders not be able to guide their companies through this, the companies that do and that do have those great leaders at the helm are the ones that are going to emerge as next generation great companies, great leaders, and are going to be able to attract the type of talent that a great company requires. So emotion is something that can be used for good, but in the wrong doses and in the wrong way can go to a lot of harm and can prevent opportunities from arising.
And it's a great place to end it, man. That was really fascinating.
Yeah, thanks, man.
Thanks for listening. You can always connect with us at skiplist.com.